Hey traders, welcome back to the channel. If you are new here, I am Marcel, the founder of Flipping Markets, and I help traders just like you to get better at trading. In today's video, I'm going to walk you through a 4-hour strategy, and by the end of this video, you will have a complete trading plan that you can start using today. Whether you're a beginner or an experienced trader, this strategy will give you the edge you need to make smarter and more consistent trades. So stick around, take notes, and let's just begin. Alright, so let's just break down the trading plan step by step. So here's the trading plan, the exact replica of the trading plan that we are using in the Flipping Markets Academy. So just as I told you, we are trading on the 4-hour time frame, right? So this is the only time frame where we are looking for trades. We are doing the analysis here, we are breaking down the pairs on the 4-hour, and we are executing the trades right here. No lower time frame confirmation, we don't have to look at the daily, we don't have to look at the 15-minute, no, just the 4-hour time frame. And before we start, I won't bother you with fancy edits. I will keep it really straightforward, and I will keep it simple and easy, so you can all understand what I'm talking about. Okay, so just as I told you, 4-hour time frame. This is the first step of the trading plan that you should identify the trend on the 4-hour time frame. Really simple, right? So on the 4-hour time frame, technically we can have 2+1 trends. One is bearish, second one is bullish, and the third one, is a ranging market. But we will talk about the ranging market in the next video. So after we identify the trend, we identify if it's bearish, if it's bullish, we have few steps to complete. There is always a first step to complete, is that we have to identify if it's a continuation or a reversal trade. So let's say that we have a bearish trend, right? We just took a look at the 4-hour time frame. We saw that price is breaking structure to the downside over and over again. We have a nice clean bearish structure. We identified it, and we now look for continuation, either a continuation or either a reversal trade. So let's just go through the continuation criteria, and let me just show you the arrow presentation of this continuation trading plan. So now we just identified that the trend is bearish. We have a really nice lower low, lower high, lower low, lower high system where price is breaking structure to the downside over and over and over again, putting new lower highs, creating new lower lows, creating new lower highs. So we just identified that the trend is bearish. Just as I told you, after identifying the trend is bearish, we either have to look for a continuation or a reversal trade. What I prefer to trade is the continuation. Continuation trades will always have a higher win ratio than the reversal trades. So what is a continuation trade? Continuation trade is basically when price continues the previous structure. So if the structure, the trend is bearish, moving to the downside, we are looking for the continuation of this trend, so we are looking for more bearish trades. What is a reversal trade? Is when price reverses and basically switches the previous structure, previous trend to a new one. So from bearish it reverses to bullish. But for now we are focusing on the continuation. So this is a really simple plan that we are following for each of the bearish continuation trades. First of all, we just identify that we are looking for a continuation trade. This is a step-by-step plan that you can follow along. Just simply tick off the steps, tick off everything. If all of the steps are done, all of the criteria, we call these criteria, all of the criteria are fulfilled, we can enter in a trade. And if one of the criteria are missing, we are just simply skipping the trade and we are not trading. Because we have 6 simple criteria that should be fulfilled before entering in a trade. If all the 6, technically 5+1, so 5 should be fulfilled. 1 is just +1 confirmation, you will understand it. So if all the 5 criteria are fulfilled, we are entering in a trade. We know that if the 5 criteria are fulfilled, like this, then it's a high probability trade and we can enter in the market. If one of them are missing, we are not entering because we know that that has a low probability to actually hit the TP and we are just looking for the next opportunity. Basically, that's why we have 14 pairs on our watch list, technically 15 now. We are adding new pairs month by month, but for now we have 15 pairs on the watch list. And since we are trading the 4-hour time frame, on one pair you will find 2 to 4 to 5 trade opportunities every month. But if you are having 14 pairs or 15 pairs, you have plenty of opportunities to trade. So we are not going FOMO. We are just simply waiting out for the criteria to happen. If the criteria are there, we are entering in a trade and we are making money. But look at the criteria step by step. So we have a continuation scenario. We are looking for continuation trades. We are looking for the sweep of the previous high. This is the first criteria in a continuation bearish trade. Sweep of the previous high. What do we mean under this? That price is moving to the downside, creating, the series of lower lows, lower highs. And when price sweeps the previous lower high, the less recent lower high is getting swept out. So this is the less recent lower high. If this is getting swept out, price wicks above this high point, not breaks above with body closure, but wicks above. And then after the sweep of the liquidity, this is what we call sweep of liquidity, because above all of these highs, above all of these lower highs, lots of buy stops are located because reversal traders are looking for the reversal in the market, and they think if that this high point is broken, the trend is changing and they will be looking for the long reversal in the trend, right? But what market is doing in reality is that actually it's just collecting all of the buy stops. So, just imagine that lots of buyers are placing their buy stops right here. And when those buy stops are actually getting triggered, someone has to sell their positions. So banks can open lots of sell positions on these stops, which equals to the following continuation of the actual bearish market, because the buy stops are collected, the liquidity is freed up, banks can actually open the new sell orders because there is the freed up liquidity from the buy orders. Then market will just simply continue to push down, and this is where market makers are actually wiping out all of the existing liquidity and doing the liquidity manipulation into their favor. So this is the first step. We are looking for the sweep of the previous high point. After this is happening, we are just looking for the next simple criteria, which is the break of the previous low point. So this is done. We have the sweep of the previous structural high point. Now we are looking for the break of the previous low point. And when the break of the previous low point happens, what do we mean under this? If the last recent lower low is breaking with body closure, now we need a body closure. So price has to body below this low point, not just wick below, where price only sweeps the high point with a wick. Here we have to see a body closure. When this happens, we can check the next criteria. Really simple trading plan. Sweep of the previous high point, break of the previous low point. Tick tick. Okay, what do we look for? What is the next step? Volume on the break. So on this movement right here, there should be volume. What is volume? Volume is really simple. I will explain it in like 30 seconds. Volume is when there are 3 candles. First candle is here, second one is here, and the third one is here. What do we call volume? Is that when there is a gap in between the first candle's low point and the third candle's high point. So if the wick in the middle here, for example, here is the first wick of the first candle, and here is the wick of the third candle, the wicks are meeting in the middle, then there is no volume gap. But if these wicks are not meeting in the middle, and this is where the first candle ends, this is where the third candle starts, this is the gap, this is the volume gap we are looking for. So this is the third criteria. There has to be a volume break. If there is a volume on this movement, then the third criteria is fulfilled. Next one, order block created. There has to be an order block on the movement that creates the break of structure, and ideally the order block has to be above the 71 Fibonacci level. You will understand that what is the Fibonacci level. So here is the volume on the break. We have it, and now we are looking for the order block. If there is an order block that started the volume and started the structure breaking movement, then this criteria is fulfilled again. We can tick it off. Now we have 4 criteria. Next one is the Fibonacci. You should pull the Fibonacci when there is the sweep of the previous structure and the break of the previous low point and the retracement starts. So Fibonacci is a really strong criteria because it shows the actual area of interest where price might retrace to the downside, and combined with the order block, this is a really strong area of interest where price will likely to follow the continuation of that structure. So what do we do with the Fibonacci? We actually pull the Fibonacci from the high that swept out the previous lower highs structure. So here is the protected high. We call it protected high because it swept out the liquidity from the previous unprotected high. So we pull the Fibonacci from this high point all the way down to the low point that created the break of the structure. And when the retracement starts, you just pull the Fibonacci. So just simply grab a Fibonacci tool. Let me just show you. Here is the Fibonacci tool. Grab it. Pull it right here from the high to the low, and you have this setup, right? The setup is really simple. You just have to put 0.71, 0 and 1. This is the only option we are using, nothing else. Really simple setup. So this is the last criteria, and there is additional criteria which is optional. Actually, the optional criteria is not necessarily have to be there. It's just an optional criteria that could happen. If it happens, then the trade will get stronger, but it's not a must. So if the optional criteria, which in this case is the liquidity plus, is missing, then you can still enter in the trade. Just know that the trade with liquidity plus has a higher chance to actually hit the TP, because that's just an additional confirmation. But liquidity plus, what do we mean under this? So if price, for example, after retracement here, it creates a double taps just like this, or triple taps, or any kind of liquidity, middle of nowhere reversal, trap, any kind of liquidity is getting created here for the limit order entry, we take the criteria off and we have +1 criteria. When all of the criterias from the list here are fulfilled, we can set the limit orders. This is the last step. We set the limit orders. Okay, so how do we set the limit orders? Really simple. We set the limit order, first one on the 71 level. One limit order goes there, and the second one goes to the order block. Yeah, we set 2 limit orders per trade idea. And how do we usually risk? Here is the risk that we are using. We are using 1 to 2% per trade. I actually recommend you to use 1% per trade idea if you're trading on a platform account, and use 2%, or even, I won't recommend you to go higher than 2%, so maximum 2% if you're trading on a personal account. Okay, but how do you split the risk? What do you do right here? You just simply, I just deleted everything from here, never mind. So you just simply place, let's just say that you're trading on a platform account, you place 0.5%, 0.5% risk position here on the 71 level, and you use a 0.5%, 0.5% position on the order block. For the Fibonacci position, you are always targeting the less recent low point, which will be this one. This is, the 0 level of the Fibonacci. And for the order block position, you are always targeting 2 risk-reward ratio. Not less, not more, only 2 risk-reward ratio for the order block. I don't care how big the order block is, I don't care how small the order block is, you are always targeting the 2 risk-reward ratio on the order block. And that is the golden rule, because this order block has a 70 to 80% chance to hit the TP. And the logic behind this order block trade is really simple and actually brilliant, because what we do here is we set the limit order on the order block, set the limit order on the Fibonacci, and when price comes back up to the order block, it has a really high chance, actually 70 to 80% win chance right here to hit the TP of the order block. And when price just simply retraces back up and won't go down to the actual TP of the Fibonacci, you still make money on the movement, you still have a positive win rate, and you still book 1 risk-reward ratio overall on this idea when it's a losing idea. Because let's just imagine that you are only setting the Fibonacci limit here and not using the order block. Yeah, price comes up, tags you in, you will be in the trade, yeah, very nice. Okay, and here suddenly price decides to actually reverse to the upside and sweep you out from the trade. Yeah, that's a loss. You can't do nothing about it. But if you have an order block limit right there, here, that 2 risk-reward ratio TP realistically has a really high chance to be hit, 70 to 80% win chance right there. So if price comes down here, and once again it reverses, decides to not fulfill the trade idea, decides to reverse to the upside and sweep you out from the trade, you still have made 2% on the order block trade and minus 1% on the Fibonacci trade. So in overall, you still booked 1%/1 risk-reward ratio on the trade idea when it's a losing trade idea. And when price comes down to the full TP of the Fibonacci, you have made 4.5% or 4.5 risk-reward ratio on this trade. Really brilliant. Really brilliant. Trust me, try it out. The order block, backtest it. Just do me a favor, do yourself a favor, hop on a backtesting session and backtest the order block win rate. Really high, 70 to 80% win chance. And this is why you can have a really high win ratio with this strategy, because the order block position has a really high chance to hit the TP. Therefore, you are not losing on the losing ideas. You are still winning. You are making money on the ideas that are actually reversing back down to the stop loss, and you are still making money. This is the simple plan. This is the simple plan of the continuation. And obviously, we use the same one for the bullish scenario, bullish continuation. Let me just show you. Here is the yeah, this is bearish reversal. Let me just find it real quick. I drew everything for you. Hey, here it is. Bullish continuation. Obviously, we use the exact same plan for it. With the switch that we look for the sweep of the low point, break of the high point. But obviously, we identify the trend on the 4-hour time frame. See, it's bullish. We are looking for the sweep of the previous structural low point. We are looking for the break of the previous structural high point. Volume, order block, Fibonacci limit set, but everything stays the same. We have the 71 level, the order block, everything is the same. It's a continuation trade. Now let's take a look at the reversal trade. Then when after we finish with all of the explanation on these arrows, we will switch to live charts. But now look at the reversal trades. So for reversal, what do we look for? In a bearish trend, in a reversal trade, we look for the sweep of the previous low point. This is the difference, right? Let me just show it on the bullish example. So on a bullish continuation, we look for the sweep of the low, break of the high. But for a reversal, we look for the sweep of the previous high and break of the previous low point. Everything stays the same after this because basically we use the same criteria for every kind of entry here. Sweep, break, volume, order block, Fibonacci limit, additional liquidity plus. So here is the bullish reversal. Let me just copy and paste the criteria. Here are they. So we are looking for the reversal, right? What do we mean under reversal? Price is moving in a bullish trend, breaking structure to the upside over and over again, creating a series of new higher highs, higher lows, higher high, higher low, higher high, higher low. Yeah, okay, we got this. So in normal case, we are looking for the continuation where price sweeps out the low point, breaks the high point, and continues to the upside. But in a reversal, we are looking for the sweep of the high, break of the low point. And this is the second type of entry we are using. We are only looking for continuations and reversals. Here is the reversal. In a bullish example, price goes for the sweep of this high point. It's important again that it has to happen with a wick. It has to go above with a wick and then it has to reverse to the downside. So sweep of the high point, logic is the same. Buyers are looking for the continuation of the trend. Lots of buy stops are located above this level. Those are getting triggered. Banks can actually sell their positions because they have to buy, so someone has to sell. There are more sell positions fulfilled than the buys, so obviously we will see the transmission in between the longs and shorts, sells and buys, and you will see a nice bearish push to the downside after a sweep of all of those buy orders. Their liquidity will be used to actually manipulate the trend, to reverse the trend, and when this happens, we can look for the next step, which will be the break of the previous low point. So sweep of the high point with a wick, and then after this we look for the break of the low point with a body closure. So we are looking for the candle body close below the previous low point. If it happens, once again, logic is the same as in the continuation. We look for the volume on the break, we look for order blocks, and we look for the Fibonacci, and then setting the limits. Optional liquidity plus. Really simple, right? So we are looking for the sweep of the high point. If there is a wick sweep, we are looking for nice volume push to the downside with an order block created and with body closure followed with the break of structure. We are looking for an order block somewhere around above the 71 limit order here. And if everything is there, we just simply pull the Fibonacci from the high to the low. This is the high point, the first of the Fibonacci level, and this is the 0 level. We pull the Fibonacci, we set the limit order on the 71 level, we set the limit order on the order block, and there you go, ladies and gentlemen, there is your trade. Really simple reversal, really simple continuation, and now let's just take a look at live examples, because you get the idea right here. Now you have the complete trading plan, really simple, but I have to show you the live examples because that's where you will actually understand that how this system is built up and how easy it is to replicate. So stick around and see you at the live examples. Alright guys, so here are the live examples. But before we continue, I would like to kindly ask you guys to subscribe to my channel, leave a like and comment something below because it's literally free. For the value you get here, it's free. It takes like 5 seconds of your time and I would greatly appreciate you if you could do that. Alright, moving on. So in this live example, the first one, I will break down a continuation trade. With all of the criteria I showed you, it will be a really straightforward, simple breakdown. And the breakdown will be based on the signal I have sent for the Academy members, because we have a Flipping Markets Academy where we do lots of stuff. For example, we gather up at least 3 times a week in a live webinar, and we just break down the whole watch list. We have a watch list right here with all of these pairs, and I am personally breaking down everything for these guys every single week, at least 3 times a week, going through all of the trades, pairs we have here, setting limit orders together, because if I spot a trade, I just set the limit order, and all of the guys, all of the Academy members can set the trade with me and can make money on the trades. So basically these are live signals, and all of the webinars are recorded, so everyone can watch them back. It's all uploaded to our brand new members portal. Every video can be found there from the past also. So yeah, it's a really nice thing because we are trading together as a community. But when we are not having a webinar, for example, on non-webinar days, I'm just sending out signals like picture signals like this one on the picture, or sending out case studies, recap videos. So we are doing really lots of stuff in the Academy. But yeah, let's just take a look at this specific trade idea that I sent out for the community members, for the Academy members. And something is laggy with the screen. Okay, now it's back. So here it is, AUD/USD. Here is the trade idea. Let me just show you in a better resolution. Here it is. So this was the simple trade idea signal that I have sent out for the Community Academy members. And let's just break it down that why we had a limit order here on the order block, why we had a limit order on the Fibonacci, why is this high even a good high to set the limit order on. So let's just briefly break it down, because after the breakdown you will get the whole idea of how the trading plan works. So what has happened here is that price swept out the swing high point with this huge wick. It doesn't really matter, because what has happened before this movement that I'm going to break you down, it doesn't matter. But for the context, I'm going to show you that, yeah, price swept out the swing high point and then started to reverse. After the reversal, it started to form a beautiful bearish order flow, leaving a high point behind, coming down, leaving a low, and then a lower high, and then a lower low, lower high, lower low. So what we see right here is a bearish structure. We had a beautiful bearish structure coming down, breaking down the low points over and over again. So what we are looking for in this type of structure is obviously continuation trade or a reversal one, because there's no other existing trade opportunity can form. So we are either looking for a continuation or a reversal. What has happened here is that price has swept out the last recent lower highs structure. So it was coming down, creating a pullback, forming a lower high, forming a new lower low, lower high, lower low, breaking the structure over and over again. And then after the last lower high has been formed right here, let me just mark it for you, just right here. After this last recent lower high been formed, price went above this high point and swept it out beautifully with a wick. You can see that it went above the high point, swept out the high point with a wick, and then what has happened, it dropped down to the downside and broke the last recent low point with an impulsive breakout structure. So what the criteria were, the first criteria was a sweep of the high point, right? So sweep of the high point in a bearish continuation scenario, it's thick. There's a beautiful sweep of the previous high point. What has happened after this is that price broke the structure. The last recent structural low is broken. So we have the second criteria thick. Perfect. Very, very nice. What else do we need? We need an order block and we need volume. So what has happened here is that after sweeping out the high point with a wick, and it did not body a bow, it just only wicked the bow and then immediately reversed to the downside and then broke the structure with a body closure. So you know, this is important. This is what I explained, that for a bearish continuation we need a sweep of a wick and then a body closure for the break. And after the sweep has happened, price left behind volume, because just as I explained, here is the volume created in between the first candle's low point and the third candle's high point, and in this region we have the volume gap. Perfect. Price usually tends to fill up these volume gaps because it attracts price. Don't ask the logic behind it. I won't explain because it will take like 40 minutes to explain, but it attracts price action. These volume gaps are usually getting filled up. Okay, what else? We had an order block. Why? Because this is the order block that has initiated the whole movement to the downside. So when all of these criteria are fulfilled, what can we do? We can put the Fibonacci from the high of the, swept out the previous structural high point. This went above it. This is the sweeping point, and we just put the Fibonacci to the highest point of the sweep, and we put the Fibonacci 0 level to the last recent low point after the breakout structure. Really simple. I usually just, use my magnet. If you press down the control button, and let me just show you, you click on the Fibonacci, press down the control, it automatically sticks to that point. So it sticks to here, and then release the control, press it again, and it will stick to this low point again. And now you have the perfect coordinates. You just double click on it, click on the coordinates, and here I just like to scroll with my mouse. This way you can buffer the lines so it looks better, and you can set the limit precisely. I just buffer the order block also, and here you go. What did I say? We are setting the limit orders on the 71 level and on the order block level. So what we do right here is simply set a limit order on the 71. I just usually place it right here. Use the simple control trick right here. Sorry, this is not even the lowest point. This is the lowest point. My apologies. So yeah, this is the lowest point. Let me just buffer the coordinates a little bit once again. Yeah, double clicking, reading the number 228, entry price 22. No, it's not right. Like this. Okay. Placing it right there, placing it right here, using the control trick, duplicating the position because we are using entry on the order block as well. This is what I told you, that you are splitting the original risk in between the order block and in between the Fibonacci position. And right here on the order block, we are using a simple 1-to-2 risk reward ratio TP. You know that. I just explained it in the previous part of the video. And now you are ready to go because your setup is ready. What else we can see right here is that price formed liquidity. We have a nice little liquidity trend line built up for this position. So we have a +1 criteria as well. So it's all ready to go. This is a signal I sent for the members, for the Academy community. You can see it's exactly the same, and the logic is pretty simple, following the criteria once again. Sweep of the previous high point, break of the previous low point, volume on the break, order block right here, Fibonacci is pulled, there is the liquidity plus, we can set the limit orders, and everything is ready to go. Really dirt simple strategy, dirt simple criterias. You can literally print money with this strategy if you master in it. All right, first you have to master it. Backtesting, gather data, just get confident with the strategy, then you can literally print money with it because it's simple. It's on the 4 hour, single time frame analysis. You don't have to switch over 5 different time frames. Just here on the 4 hour one, you can print money, and that's it. Basically, I just press the replay button, and you will see that price came back up to the entry, tagged us in perfectly on this line. It also tagged in the order block limit, and actually on the same movement, I mean on the same candle that tagged us in, it immediately TP'd us out. So 1 TP there, let's just play it forward, 2 TP, perfect, double position, double TP, 4.5% profit gain. Because here on the Fibonacci position, we have a 2.5 risk reward ratio, on the order block 2 risk reward ratio, perfect position. So this is the live example of the continuation. Now let's just take an example for the reversal. And here is the reversal example, showed on gold. So once again, we are looking for a reversal right here. And let me just show you the trade idea that I sent out for the Academy members, because this is a really important thing in the Academy, that we are executing every single trade together as a community. So if I personally execute a trade, I'm sending it out for the Academy members, and everyone can execute the exact same trade with me. So that's the power of the Flipping Markets Academy. Executing every single trade together, learning, winning, earning, losing, doing everything together as a real community with a real mentor. So here's once again the trade idea that I sent out for the community members, and here is it in 4K. Alright, so let's just break it down again, that this is a reversal trade, and what we are looking for here, this is a short bearish reversal. So we are looking for the continuation of the bullish trend, and then a sweep of the high point, reversal, break of the low point, and then a nice short reversal trade. So what has happened here is that price went down to this bottom. We will start counting from this bottom. From this bottom up, price started to move up, creating a series of higher highs, higher lows, creating these points. At this point, when this low point being printed, price started to move to the upside again. But what it did right here is that it could not break above this previous high points structure. It could not break it with a body closure. Instead of breaking it with a body closure, it just swept out the liquidity with a wick. And now at this region, let me just replay price back to this region. At this region, when the sweep has happened, and let me just play one more candle. At this region, this sweep is unconfirmed. This is not a confirmed sweep yet, because price can easily continue the movement to the upside, can easily body above this previous high point, and that way it won't be a confirmed sweep. What do we need in order to get a confirmed sweep? Obviously the second criteria of the list, which is the break of the previous low point. So after the sweep of the previous high point, we need the break of the previous low point. Sweep of the previous high happened, we are waiting for the break of the previous low point, just like I showed you on the drone arrow movement. And now at this candle we have the break of this low point, so there is a really nice break of structure. And now the sweep right here, this one is a confirmed sweep, because the sweep being confirmed with the break of the structure. So we have two criteria ready. We need the rest of the criteria, which is the volume, which is the order block, which is the Fibonacci, and additional criteria is the liquidity plus. So what we have here is obviously a really nice volume in between the first candle's low point, third candle's high point. There is a really nice volume gap given on this region. Okay, so we have a volume gap. What else do we have here? Obviously an order block on the top of this movement. Very beautiful order block. What do we do after we have an order block? We have a volume, we have a sweep, we have a break. We are pulling the Fibonacci from the high point to the low point using the control magnet, and then buffering the coordinates. What do we do after this? We are ready to set the limit order, because we don't have to wait for the additional liquidity plus criteria. We are just simply setting the limit order, and if the liquidity plus is getting formed, that's a nice sign that, yeah, it's even a stronger trade that you can take. Okay, so one limit goes to the Fibonacci level as always. Let me just, use the control, and the second limit order goes to the order block right here, targeting 1 to 2 risk-reward ratio. Always, every single time you are just targeting 1 to 2 risk-reward ratio. And now you are ready to go, ladies and gentlemen, because you have a beautiful bearish reversal trade from a bullish structure transmission into a bearish structure, sweep of the high point, break of the low point, order block, volume, Fibonacci, limit set, everything is ready to go. So let me just play price forward. There is a tag on the Fibonacci level, there is a tag on the order block, and as you can see, the order block immediately gave the rejection and it immediately tipped the position out. So just like this, in one single candle, you could have made 2 risk-reward ratio, and in the community we have made because we took this trade together as the signal was given, and all of the community members, hundreds of members, executed the trade with me. And let's just play it forward. Yeah, it came back up for a little bit of grab, liquidity grab, and then it dropped down and TP hit on both of the positions, on the order block, on the Fibonacci. Every position is hit just like this. And you did nothing. I mean, literally you have sacrificed like 3 minutes of your time to do this analysis right here, because drawing a sweep, drawing a break, identifying volume and an order block takes like 2 minutes per pair. And that's why I say that you need 30 minutes a day to trade this strategy. 30 minutes. And that's all it takes, ladies and gentlemen. And I hope you enjoyed this video, because I gave you my trading plan. Based on this video, you can start making money, you can start catching the trades that I showed you based on this simple trading plan. So once again, if you are interested in our academy, check the link in the bio, in the description. You are very, very welcome there to join us. We are waiting for you in the academy. Hundreds of money-hungry students are there with me. So yeah, thank you for watching once again. Subscribe to my channel, leave a like, leave a comment below, and see you in the next video, guys. Take care and cheers.